Welcome, real estate friends. Thank you so much for joining me on this amazing day. I'm excited to talk to you about this current topic about depreciation and cost segregation. This is so important because if you understand this concept, this is how billionaires and millionaires pay $0 in taxes. Wow. Isn't that amazing? I find that amazing. I hope you do too. So, we're going to talk about this, and it's a very simple strategy. It's very easy to understand. We're going to go through an example as well for each and go from there. Okay, great. So, before we get started, please like, comment, and subscribe. This helps me out, helps you out, helps the whole world out. So, please do that. And as also a reminder, if you want a detailed analysis in this written form, you can check out the link in the description below. It has a full blog post covering this exact topic. Cool. So, depreciation. Depreciation is a phantom expense or a non cash expense. It is a tax deduction that the IRS allows you to do. It's actually required in real estate. And what it allows you to do is to decrease your taxable income. So it goes like something like this. Uh, Say you have a commercial multifamily real estate property and you bought it for $3 million, right? Now, it's important to note that in this specific case, uh, a multifamily or apartment buildings are called residential properties, which traditionally speaking, 5+ units are commercial, and anything less than 5 units is residential. But for the tax code, all apartments are considered residential properties. Commercial properties are things like office buildings and stuff like that. So, it's important to note that because the tax code eliminates between the two. Residential properties, single family homes, apartment buildings, mobile home parks, things like that, can be depreciated over 27 and a half years, with commercial properties being able to be depreciated over 39 years. So it just helps with the math. What's nice is these residential properties have more of an accelerated depreciation schedule, which is really handy. So back to our example. You buy a multifamily property for $3 million. Now, you can't depreciate land. Land is not allowed to be depreciated, so you have to determine the value of the land first and foremost. Let's say, to make our numbers easy, say the land is only worth $250,000. So your building is a total cost of $2,750,000. It's just a $3 million minus the land of $250,000. You get $2,750,000. Now, what you can do is you divide that by 27 and a half years to get how much you can depreciate per year to recoup the cost of the investment. And that comes out to $100,000 a year. What's nice about that number is if you say make $100,000 a year in net income, what you can do is you can write off $100,000 in taxable depreciation. So you have $100,000 in net income minus the $100,000 a year in depreciation, and you have a $0 tax liability, a taxable income, a $0 taxable income. How great is that? That's amazing. Now, there's another thing to note here. If you're a professional, which constitutes a couple things, I'm not clear. I'm not remembering exactly the two factors, but it's something along the lines of you have to spend 750 hours or more doing real estate, and you have to consider your real estate objectives as your main occupation and real estate objectives. If you're considered a professional, then what you can do is you can actually take your depreciation and whatever leftover, if you have a negative taxable income, you can carry that forward, and you can apply that to other types of income like active income from your W-2 job or other rental incomes and stuff like that if you're a professional. So that's one thing to note. If you're not a professional, you don't have that ability, but that's fine. It's still, you can still get the tax advantages of your property in itself. Okay. So that's what depreciation is, right? So you take the value of the property, just the building itself, you divide it by 27 and a half years, and you get the amount you can depreciate over that per year for that 27 and a half years, and then you can write that off, and that's a deduction against your taxable income. Now, cost segregation is a way that came out in the tax code in 2017 that allows you to accelerate your depreciation based on a couple things. It classifies fixtures, personal property, and a couple other things as parts of the property that can be depreciated in an accelerated fashion. That means you can depreciate, carpets, doors, lighting, stuff like that at an accelerated rate. So to make our math a little bit, to make our math simple, let's go back to our example of a $3 million purchase price. Let's say the land itself was not $250,000, but was just $150,000. So you have a property of your building being $2,850,000. Say $100,000 was determined as personal property that you can do a cost segregation analysis on, and you can accelerate that depreciation, let's say over 5 years for personal property. Okay. So $100,000 is depreciated over 5 years, which is, in my mind, real quick, that's $20,000 a year, and you have the remaining $2,750,000 as before, depreciated over the 27 and a half years. That's $100,000 a year. So that means for the first 5 years, you can depreciate $120,000 a year, and then after that 5 years, 6 years through 34 years, or not 34 years, 22 and a half years is just $100,000. Again, the first 5 years, because you take the personal property of $100,000, which can be depreciated not over the 27 and a half years, but over 5 years. It's an accelerated rate. That's $20,000 a year. And then the remaining part of the building is the 27 and a half years. That means the $20,000 a year for personal property plus the building depreciation. That's $120,000 a year depreciation for 5 years. The remaining 22 and a half years is just goes down to the $100,000 a year because you have used up the depreciation for the personal property in the first 5 years. That's cost segregation. This is a extreme advantage for real estate investors because it allows you to accelerate your depreciation, maximizing ROI, maximizing your take-home income, maximizing your cash flow, maximizing your ability to do improvements on the property, maximizing your investment in total. And that's it. That's depreciation and cost segregation in a short synopsis. I hope you understand it, and I hope you understand the value of it like I do, and hopefully that helps you in your apartment hunting. So happy apartment hunting. Thank you so much for watching. Please like, comment, subscribe again, and we'll see you next time. Your multifamily real estate expert, Connor Scott McCarl, out.